All right. All right. Good morning, everybody. Welcome to our third rendition of Life Insurance Awareness Month series webinars. We are very excited for our presentation today. This is our first presentation on estate planning. We've done a lot on business owner planning. So if you missed any of it, this webinar, as well as the past ones, have been recorded up to this point. So you can definitely go back and check them out. Otherwise, we are very excited to have Joey Ussery here live with us for this wonderful presentation. If you were on just a second ago, we were chatting about the Q&A box. If you do have any questions as we're presenting, we might interrupt Joey depending on how the flow of the question is with the conversation at that moment. Otherwise, we'll hold the questions till the end. So definitely drop the questions as you think of them, so that way we can hit them at the end if they weren't answered, in the following slides and things like that. So with that, we'll go ahead and get Mr. Joey Ussery and John Hancock started. The floor is yours, sir.
Awesome. All right. Well, thank you. Thank you very much. I appreciate it. Elizabeth and Vanessa, thanks for taking care of me and making sure that I was able to get everything up up and running. It's always the nerve-wracking part of doing these things, but I find since COVID, we're all pretty comfortable with it. How many of these have you had where you're like, our speaker hasn't shown up yet and we have no idea, but we're glad that you're here. So but I do appreciate the opportunity and thank you for that, and thank you for the business and the partnership. And it is an honor to be presenting during Life Insurance Awareness Month, and which I think is an outflow of Life Happens, and a number of our industry organizations. So I would just like to put in a little commercial for the professional associations that support our industry, whether it's NAIFA or Society or HEF or the Financial Planners Association. I'm always reminded that we're better off joining together and working together for a common purpose. So again, appreciative of Life Insurance Awareness Month. I will tell you up front that I am a life insurance wholesaler. I'm John Hancock's regional VP. I'm responsible for life insurance sales. Fortunate enough to work with Elite or EMG. I'm a dinosaur when it comes to that. But I wanted to tell you all that just to say that to me, the solution to all of life's problems is more life insurance. And Elizabeth, I know you've heard me say this before, but like if your car breaks down, it's because you didn't have enough life insurance. In Houston, if the hurricane blows your roof off and your house floods, you didn't have enough life insurance. If your kids are acting up or your spouse doesn't like you at the moment, you probably should have had more life insurance. So just put that caveat in there. Elizabeth, I think we picked this presentation because we liked the content, right? But the title has kind of grown on me as time has gone by: estate planning with life insurance in a rising interest rate environment. And it's kind of a long title, but I think it kind of reflects the circumstances and the situations that we're dealing with in the industry right now, where it can be difficult to get clients to take action in different situations. And a big part of that is, what's going on with interest rates and then the environment. So before I get into the presentation, though, I always like to give you 2 or 3 different ideas, just so if you zone out and you don't listen to the rest of my presentation, you will have got 1 or 2 useful things. So the thing I always start with is if you ever call someone up and you're trying to schedule an appointment, if it was a referral from somebody, which, by the way, referrals are the best way to get new clients or prospects. If they're already working with someone, ask them, do you have enough confidence in your current financial advisor to allow me to give you a second opinion? Do you have enough confidence in your current financial advisor to allow me to give you a second opinion? I'm going to stop my video there and see. Okay, I'm off screen. Am I coming through okay, Elizabeth?
Yep, you're all good.
All right, cool. So second one is, what needs to happen whenever you sit down with clients? Ask them, what needs to happen in the time that we're together for you to consider this meeting a success? What needs to happen in the time that we're together for you to consider this meeting a success? If you get them to tell you what's important, why they agreed to the meeting, you know what you're going to have to do in order to be successful. And then the third thing, which plays into part of this presentation, which is a little bit of a focus on long-term care planning, is whenever you do a review of the client's assets and their portfolio, and they don't have long-term care, you say, I couldn't help but notice that neither you or your spouse had any long-term care insurance. Is this intentional or just because nobody ever asked you? I couldn't help but notice that neither you or your spouse have any long-term care coverage. Was this intentional or simply because nobody asked you? It's a great question. You know, the implication is everybody should have long-term care. We all know 50% of all 65-year-olds are going to need some form of long-term care, and everybody needs a plan. So all right, so we'll jump into the presentation. We have the agenda and the different things that we're going to focus on here. Our clients today have a lot of things on their minds. So we're going to talk about some of those factors in the current environment that may be keeping your clients up at night. Some of the things that might be keeping them from pulling the trigger on a plan or not moving forward with your recommendations. And as I'm sure you can see, I think I have more content than time allows. So we'll try and keep this light and fast paced. And I just looked at my watch and I saw that it's 7 minutes after the hour already. The things in the focus area, those were the teasers for this webinar today. So that's what you saw. That's probably why you agreed to attend. So how do you create urgency? How do you create a sense of urgency in an environment like this? Well, there are there are a lot of different things that are coming at our clients. All those different economic forces. We know inflation is of concern to clients as well as market volatility. And I read something yesterday that was talking about market volatility. It was making the point that the market really isn't as volatile as it could be or has it's been in the past, but that really doesn't matter because it's the perception of volatility and the perception of interest rates that can cause our clients to not take different action. And if you didn't see, you know, yesterday the Fed came out and they said they're holding rates where they are for now, but they do expect one more increase of 25 basis points before the end of the year, and then they're projecting, I think, a couple of drops next year. And I think the stock market went way down yesterday after that came out. And I don't know what it's doing. I don't know what it's doing today, but it is certainly, oh, the market's down a little bit today as well. So you've got all of these different things on top of the economic forces. We've got we've got all the politics and the polarization that's going on there. You got the geopolitical instability, the question, are we going to have a recession or are we not? There's just a lot out there. So obviously, planning should always address your client's concerns. What's their agenda? Remember that question I asked. What needs to happen in the time that we're together for you to consider this meeting a success? What are your clients thinking about? What are they worried about? Um, and then we need to tailor our recommendations, our solutions to them to deal with those concerns. The fact that your clients have concerns to begin with is really a good thing, not a bad thing, right? If you were ever involved in sales training, you know that in this industry they taught us that you've got to disturb the client. You've got to do something to get them to think about the worst case scenario or the consequences and how the products and solutions that we have can solve those problems. So the key is to deal with your client's concerns. If the client's expressing concerns about losing money, well, you might consider putting them into an IUL policy where they can track the returns of different indexes. You know, there's a cap on it, but the trade-off is that they also have a floor to protect them against negative returns. If guarantees are a concern, you have a whole slew of products out there that can deal with that with guarantees. Our protection VUL policy will let you guarantee a policy to 100. There, you know, you think about everything, whether it's annuities, that sort of thing. Something that we didn't really put in this slide is another thing would be to provide your clients with flexible solutions or like flexible product designs. we were taught in this business, the first thing you do whenever like you're selling life insurance or long-term care, you sell the right amount and then you structure the solution to match the funds that are available to to buy as much coverage as the client needs. The fourth bullet on there talks about inflation's impact, and clients are worried about that, the purchasing power of their dollar. And as it relates to estate planning, we'll look at how inflation and interest rates can have an impact. And then when it comes to long-term care, long-term care issues and concerns, which I love that part of the market. It's one of the few areas where clients will actually approach you and will be very open and interested in the idea of protecting for long-term care. And a lot of times, there's a trigger event for that, and your clients in their late 40s, 50s, even 60s, or the sandwich generation, taking care of their kids and then also needing to take care of their parents, or they have friends that end up in different situations and they see the consequences of what a long-term care event can do to the family and to the finances. And so, we're fortunate that we have products that can solve those different issues. So many opportunities, so little time. Um, this slide shows the effect or the impact that inflation can have on on your money. So this looks at $1 million, and it says that what would happen to the purchasing power of $1 million over time. Or let's look at it from the standpoint of, you have a client that wants to leave $1 million to their to each child, or to their child. And so the idea is, I'd like to give them $1 million in today's dollars. Well, in a 2% interest rate or 2% inflationary environment, if you look down at the bottom of the page, in order to provide $1 million worth of purchasing power in 20 years, you'd have to have $1,485,000 to do that. At 3%, you'd have to have $1,000,008, and at 4%, which is a relatively low number, you'd have to have over $2 million. So the impact of rising interest rates or inflation can have a significant impact on your client's money, and then the plans that they want to accomplish. So how do we help those clients? How do we design a policy that will respond to this? What are some of the things? I know you probably already know what these are, but how about the first one? Purchase more death benefit initially. Buy the right amount of coverage. Project out into the future, right? So buy a larger policy, or you can put the return of premium rider on the policy if the policy that you're selling offers that rider, a rider that will return the premium in addition to the death benefit when the insured dies, or put an increasing death benefit, option 2 or option B, onto the policy. And then the fourth one, scheduled increasing death benefit if permitted. John Hancock, we don't have scheduled increases, but I know there are some carriers out there that do that. You might want to look at that. Or the last one, which would be to heavily fund an option 1 death benefit, and then as the cash value hits the corridor, it'll push the death benefit up. And in the later years, it can grow significantly and help keep up with the effects of inflation. So what are some additional things? What are things going on? What are we looking at? And from the estate planning side, we've got the sunset provisions happening, where the Tax Act, the Tax Cuts and Jobs Act, Elizabeth, it escaped me, and it's right there in the email. That's what I was struggling with. You might just have to step in here and do the presentation for me.
No, thanks. I'm
What?
answering one of our Q&As at the moment.
Oh, all right. Okay, so no stepping in. All right, so how do you create a sense of urgency in an environment like this? How do you know what are some of the things that we should be looking at? And I think too that we all know about is this sunsetting provision in the Tax Cut and Jobs Act, which we'll look at in more detail. And then also many states are now looking at different long-term care initiatives, providing long-term care for their citizens. But guess what? The there's a cost to those initiatives. So those are different things that you'll want to make sure that you bring up with your clients if you're in a state where they're considering doing that. That's an issue that you should talk about with your clients instead of a tax. Should they buy a policy, or if you have extremely high net worth clients, they could be affected by this sunsetting of the tax act, where the lifetime exemption amount is going to drop back. It's going to revert back to the $5 million adjusted for inflation that it was further back in time. So if the sunset happens on January the 1st, 2026, the exemption amount is going to drop down from what will probably be a 14 or $15 million exemption amount, where each person can pass that on without paying estate taxes. That number is probably going to drop from that somewhere down to what we think is going to be in the $7 million range. And so overnight, their potential estate taxes could go way up. We're going to focus mostly on this particular idea in terms of the sunsetting provisions that are inside of the of the Tax Act. But even if your clients aren't concerned about the exemption amounts, or even if your clients are not going to purchase life insurance to pay for the estate taxes, you'll want to make sure that your clients are doing everything they can to maximize what they can leave. And you're going to want to make sure that you encourage them, like if they need to see an estate planning attorney, a estate tax attorney, that they try to get on the calendar now, because as you get closer to that deadline, it's going to get harder and harder. I had an attorney the other day tell me that their calendars are filling up, and it's like 6 months out that they can visit with a client. And if you have a client that wants to buy insurance and you want to put it into an irrevocable trust will need to be set up. Well, you could be looking at 6 or 8 months possibly for that. And I think some of that is what we're seeing in terms of the expansion of the time frames that it's taking to place life insurance. But that also reminds me of an idea, Elizabeth, which is the Magic Six. And I don't know if you've ever heard about it, but one of the best sources of referrals would be referrals from centers of influence, and centers of influence that are professional. So I read this article that said that a financial advisor recommends to all of his clients that they have 6 key advisors in their life. And those advisors would be a CPA, a financial planner, it'd be an insurance agent. If they were different, it'd be the CPA, a mortgage broker, all of those professionals. And so whenever you're doing your annual review with your client, you would say, or with a prospect, you say, I recommend that all my clients have advisors. Can you tell me who you work with? Oh, good. You get the names of their existing advisors, and then where they don't have advisors, you can then refer centers of influence that and work with to work with them. But for those that they give you, you can then say, I'm sure I hope it would be okay. I'd like to reach out to them just to introduce myself, and make sure that we're coordinating. You now have the name of another, potential center of influence, another financial advisor. And you think about it, if you have 5 client meetings a week, you should be getting potentially 30 different names of people that you can call on. You then go visit with those financial advisors, you show them what they do. They're so impressed with your planning and your process that they ask if they can be your client, or hopefully they will begin referring clients to you. And you call that the Magic Six. And then you can drip on them with different things, stay in contact with them, which, by the way, we do have some great material. All right, so I just threw that in. That probably just messed all of our time up, Elizabeth, but it is. I love this slide. What's the big deal? Yikes. Well, if you look at this, we're showing a client with a $20 million estate, and we're saying what would be the estate tax liability today versus what would it be on January the 1st of 2026. And if you look down at the bottom of the page, I mean, the bottom of the slide there, you'll see the estate tax in 2023 for an individual with 20 million would be 2.8 million. That'd be the estate tax. But January the 1st of 2026, tax liability goes up to 5.9 million, or a $2.9 million increase overnight. So your clients may want to take advantage of the fact that for your ultra high net worth clients, if you have clients in that range, you would want to encourage them to consider taking advantage of that. But also remember, sometimes it gets crazy when we look at these huge numbers and we project too far out into the future. But for your client that's 65 years old, what's the likelihood that they would die in 2026? The reality is life expectancy for probably a 65-year-old male would probably be what, 18 years, maybe a little bit longer for a lady. So what does it look like that far down the road? Also, where's the liquidity going to come from to pay these estate taxes? The taxes typically due 9 months after the date of death. What's your liquidity plan? Tax laws are unpredictable. I mean, a lot of things are going to change, between now and 18 to 20 years from now. Look at what they were trying to do with grantor trust just a couple of years ago. If people wait and they want to plan later, the cost of the insurance can go up prohibitively. I've been using a slide lately that shows the cost of insurance for a 44-year-old female, and at preferred the premium is 4,400. If you wait a year and the you're still preferred, the premium goes up a little bit, right? It goes up maybe to 4,800 or 5,000. But if instead of a preferred underwriting classification, now you're rated 150%, and you look at what the premium does, or 5 years from now and your health changes significantly, I mean, you could be looking at a premium 5 times higher than what you originally did. So again, I think we need to operate with a sense of urgency, or at least make sure that our clients are aware of the fact that they need to do planning. So again, it doesn't have to include life insurance, but for me, the right solution is always life insurance. All right, so these are the states that are considering long-term care initiatives. I'm sure anybody that's been paying attention knows that Washington State has been working on this for a couple of years. I can never remember if this is implemented. It was supposed to be implemented in July of 2023. Was it last year or the year? I think it was the year before. We had that rush of people trying to buy long-term care coverage, life insurance with a long-term care rider, which, by the way, ours qualifies because it's considered a long-term care policy. But there are a lot of states that are considering implementing a program to provide some level of long-term care, but the trade-off is they're going to tax for it. But perhaps, like Washington State, they will let people opt out of it if they already have long-term care, but there's no guarantee that that'll happen, or we don't know exactly what the terms of that opt-out will be. And so you have to be a little bit careful with this, Elizabeth. I think I read something the other day in one of NAIFA's communications where some insurance agents were using the possibility that of the fact that California would be implementing something like this soon, and um, complaints were filed against them. And so you really need to be careful, especially especially when dealing with seniors, right? Everybody is especially sensitive to that. So I think it's something that you want to bring up with your clients, especially if you're in these areas, and make them aware of it. I mean, remember, most people are going to use some form of long-term care. By the way, another line that I heard, clients that have assets a lot of times will say that they're not going to buy a policy as a solution. They'll just self-insure. And I had an agent tell me that their response to that is, I agree, you need to self-insure, and the most efficient way to do that is by purchasing a policy. Oh, Elizabeth, how am I doing?
We don't have any questions in the chat box, so as
Oh,
long as
good.
folks are good with hanging out, I mean, we can take as long as an hour or so. I
I
don't know that everybody will want to hang out for a whole hour,
No,
but
I I
you're
I don't want
entertaining as always. So I
I
would say,
I
yeah, another 10 or 15 minutes, and we can,
yeah,
pause for questions if they come in.
yes. All right.
But otherwise,
Thank
I've typed the answer.
Cool. Okay. So the one of the things we start off with here, and I kind of wonder why this is in here, because it's estate planning with life insurance in a rising interest rate environment, and we talk about doing policy reviews or annual reviews. How is that? How is that in this presentation? And it's in there because inflation and interest rates and changes always bring up the fact that you need to review the plan and see what it is and see how you're doing relative to the plan. But I also think the reason it's in here is because this is the idea, this is the thing that really works in terms of being a professional in the business. And that is that you have a plan in place to regularly review with your existing clients the planning that they've done, to review their policies, to see how they're performing, to see if different life events have happened, to get a pulse check, to look and see what's happened with interest rates. How is your policy performing? Oh, you can't afford your premiums anymore? Okay, what are our options? What kind of flexibility do we have? Policy review it's a core element to any successful business practice, and I think especially in today's environment. And I think it's always the right time to do the right thing, but needs change, lives change, laws change, products change, underwriting change, interest rates change. And this is a great way to re-engage with your clients, to uncover new opportunities. Some people, I think, don't, if they haven't done this on a regular basis, they wonder how they're going to start. How do you all of a sudden start reaching out to these clients that maybe you haven't contacted in a while? And I think the best way is to say that you have, through working with some of your best clients, you have realized that people need reviews, want to review, and therefore you're giving them the opportunity to review what they've already done. And sometimes it can be tough to set those meetings on a regular basis. I knew an agent that used to send postcards out, um, before the time that they wanted to have a meeting, and her postcard would say, "It's time to visit your money." And I thought that was kind of cute. It was a little bit different. Another very obvious way to do it is, you go to the dentist, you go to the doctor. What do? They set the next appointment as you're paying and going out the door. We'll do the same thing with your clients. When you do that review, when you meet with them, put the next meeting on the calendar. There's something refreshing and energizing about having appointments on your calendar already when you start the week, the month, the year. So I would encourage you to do that. So if your clients haven't reviewed their policies in the last 5 years, or they haven't reviewed them since you purchased it, it's in their best interest, and it's in your best interest to visit with them. And here we just talk about some of the different things: ownership, any changes, policy performance, suitability. Um, and a big one, if you look down at the bottom, business related policies, always make sure that they're in compliance with 101J. There's a responsibility every year to contact those clients. Well, there's your excuse, right? There's your excuse to reach out. And whenever you're talking to your clients, that gives you different opportunities, right? So things always happen when you're communicating with your clients. So here you might recognize this. This is interest rate history from 2000 to 2023. You see, we had super low rates for a a good bit of the time in there, right? You had super low interest rates, and now boom, rates are coming back up. In a lot of ways, they're approaching, historical rates, but perception is reality. And with interest rates now with the Fed, what's the Fed at 5.25%? But they're saying they're going to increase another 25 basis points. I think mortgages are what, up over 7%. All of those things have, make an impact. And as it relates to estate planning, I always like to say all estate planning cases are premium financing cases. Now, someone at John Hancock right now is probably spinning around in their chair whenever I say that. But what I mean by that is, for your high net worth clients, every time a premium is due, you probably want to look and see what the most efficient place is to pay for that premium. Is the best place to pay it out of annual gifts or with their lifetime exemption, or is the best way to pay that with some other entity? Is there an opportunity to get money at a low cost and use that and pay a low interest rate? So it just depends. But you can see here what's happened with interest rates. This shows the. I'm just looking because the toolbar at the top blocks out the heading, but it's May 2022 to May of 2023, and you can see that interest rates are, fairly significant, or, pretty significantly higher there. And if you go here, this slide is to October of 2023, and it shows what those interest rates are. So short-term AFR rates, just just 3 years, 2 years ago, were 18 basis points. We have a guy named Joe Sienna, who's one of our advanced marketing consultants, and every month he sends out the AFR rates. And I remember him sending those out to us a couple of years ago, saying these are historically low rates for your clients that are doing sophisticated estate planning. They should try and take advantage of these super low rates to lock in a rate of a 2% for a long period of time. There's great value in that. So when net rates were a lot lower, using somebody else's money was a lot more appealing. Now that loan rates are higher, the AFR rate is this high, and loan rates are higher. There's perceived to not be as much leverage, or it's not as attractive. It's interesting though, because where do these rates, compared to maybe the last 20 years, they may be in line with what we were looking at. It's just compared to the last couple of years, they are a good bit higher. So interest rates do play a part whenever we're looking at different estate planning options. So when we're looking at doing estate planning, it's really kind of a process where there's tension between estate planning, where you're trying to save taxes, and loss of control of those assets. And human nature, studies show us that everyone's afraid they're going to run out of money. When you don't have any money, the thought that someone with a bunch of money would be afraid that they're going to run out of money strikes you as strange. But somebody with somebody with $10 million can be as concerned about running out of money as somebody with with $100. So the natural tension, what we do is you look for the sweet spot in between what gives us the most potential estate taxes and what can provide some level of control. So you try to find the sweet spot between saving money, saving estate taxes, and still giving your clients some level of control if that's possible. And there are a number of different planning options that we can use when we're considering like a financing option. So if someone wants to try to maintain control, you want to look at a different type of a planning concept besides just giving irrevocably money to an irrevocable trust to do your estate planning, and a finance technique might help. So if someone wants to wait and see, right? If they want to wait and see what's going to happen with taxes, wait and see what's going to happen with the economy, you might want to use somebody else's money, or use money where you have strings to be able to pull it back. If a client doesn't want to liquidate or give up control of the assets, you might want to look at a different planning, a financing technique. If someone's comfortable with leverage, you might want to look at a planning technique. I always think of car dealers whenever I have a bullet or have to make a comment like that, right? They're just different occupations, a different type of people that are comfortable with debt. You could also have a situation where your clients are using their gift exemptions for something else. A lot of people like to see their family enjoy their annual gifts. They like to see the happiness that they get from receiving the gift. And if you gift the money in a revocable trust and take advantage of the crummy uh, powers, they're not going to really get it, right? It's in a trust for their benefit ultimately. But so you have competing interests for the gift exemptions or even for the exemption amounts. And in those cases, clients may want to look at different planning techniques. So whenever we're looking at designing a case, right? When you have a whole range of planning options. And there are some things that are good to know. Are the clients liquid? Are they illiquid? Are there assets in a business or real estate? What's their cash flow? How much are they earning from investments? And then the planning techniques that we use should always be in response to the client's fact pattern, like that slide back in the beginning actually said. So our planning technique, the one that's appropriate, will be those that are according, those that match the different client considerations. All right. And so here, let's see, hold on. Yeah, options for finding and funding the premium. So here we talked about taking into consideration the client's situation, and then here, where do we find the money? Well, the easiest source is through annual gifts. Secondly, would be are there already assets that are set aside? Have they already done some estate planning and money is invested or sitting in a trust somewhere? Wealth outside of the taxable estate that we could use, that we could leverage to buy life insurance. And then you have different financing techniques. So commercial premium financing, private financing, different split dollars, dual loan approach, sale to an intentionally defective, irrevocable trust, and then also possibly is your client a business owner, and might there be business funds that we could actually use. And so here are these are all financing options that could be used for premium financing. Now I know you just looked at your watch. I could tell you all looked at your watch and you're like, "Whew, what? You're not going over this, are you?" I'm really not. I'm not gonna go through all of these, but if you're looking at possibly a more sophisticated planning technique, if the client doesn't want to spend their own money for any number of reasons, these are all techniques that you can that you can use. If the client doesn't want to use their annual gifts, we so many times we just go straight to commercial premium financing where you have a, a somebody a professional lender lend the money. But there are other ways that you can do it. If the client has liquidity, but they don't have exemption amounts, or if they want to keep strings on the plan, they could loan the money themselves to the trust that the trust is going to use to purchase life insurance. But they have strings, and they're going to get repaid that principal at some point, and then they would have to be either paid interest or using the AFR, which is where those rates come in. If a client's not liquid, but they have assets in a business or some other type of entity, we look at a sale to an intentionally defective grant or trust. If the client has a lending source already, you might want to consider the grantor borrowing the money themselves, then lending it to their trust. Sometimes they can lock in longer terms, and it also gives them the ability to have access to that money. And then, we also have split dollar arrangements where the grantor pays the premium, and then they're due back the premiums that they pay or the cash value, which is ever higher. And these are all planning techniques that we would consider if the client either didn't have the liquidity to pay the premium, or if they didn't have the annual gifts or the lifetime exemption amounts, or they simply wanted to maintain control, wait and see over what would happen. But we don't know which one is the right one until we know the answers to a lot of these questions: liquidity, assets, that sort of thing. All right. And we have some great marketing pieces that talk about all of these different planning techniques, and your team at EMG has got great information when it comes to this. In fact, I was visiting with someone over there who told me the other day that they're not seeing a lot of sales to grant or trust right now, because they're finding that most of the clients want to enjoy the step up in basis that comes from death, as opposed to doing a sale right now. So again, there are a lot of different sophisticated planning techniques that depend on the need of the client. It's always important to consider exit strategies. So how are you going to unwind this? Is it at death? Are you going to unwind it out of the policy? Is there some liquidity event that's going to happen? So I would encourage you to remember that we can do flexible planning both with product features as well as different planning techniques. But looking back, because of everything that's going on in the world, it's a great time to visit with your clients, to look at what they've done, to take into consideration, need for long-term care, review their planning, take advantage of the current tax laws, the sunset provisions, or to prepare in case their state is going to have one of those long-term care events. But it's always a great time to visit with your client, and John Hancock, EMG, and life insurance is always the solution.
You seriously have
Elizabeth,
had me like laughing sitting here. Uh,
what?
I made a comment to Vanessa. I was like, he's our resident comedian, that's for sure.
Oh
Um,
gosh.
okay, so Clay is raising his hand. Oh, maybe. Well, it went away really fast. Did you not mean to hit that, Clay? Yes. Okay, he's raising his hand. So I'll go ahead and unmute him here in a second. But we did also have, so one of our attendees asked if we can send the slides to them. I believe you gave me these slides in an email a while ago. So
I
we
did.
can forward those out to everybody that did attend. And I did mention this was recorded, so you'll have that option as well. And then Jesse, one of our directors at EMG, he made a good point. Do you guys have like a microsite or something that these resources are on, or do we just need to kind of get each individual resource and then share them
Sure.
as
So,
needed?
so, so our advanced marketing department does have a microsite. Um, and as soon as I say that, I'm like, oh my gosh, do I know? I'll tell you what, I'll get the microsite
Yeah.
to you,
Okay.
but I can also, what may be easier is I can get you the different planning concepts that I covered, that I talked about here. And either you could email them out to those attending, or put
Mhm.
them on your website.
Well, that's what I'm thinking. If you just with adding on to the sending slides, if you want to, if you not right this minute, but if at some point in the near future, you can send us any sort of links or PDFs, and then we can send all of that to everybody that was on the call along with the slides.
Absolutely. Yep.
So, and
Yep.
then Clay, I did allow you're able to unmute yourself and chat. Vanessa, though, before we get too far into Q&A and discussion, can we go ahead and just stop the recording here? Thank you, everybody, who listened into the recording.